£26,000. That's what a 10% deposit costs on the average UK home today. In 1993, it was enough to buy the whole thing outright. Nobody told you the maths changed this much. Here's the receipt nobody's reading. 3 things changed in the last 30 years, and only one of them is the number on the for sale sign. The one most people miss is the one that actually explains everything. Stay till the end. The third one changes how you think about all of this. Let's run the actual numbers. In 1993, the average UK house cost around £62,000. That's straight from the nationwide house price index. By early 2024, the same average sits at around £260,000, a 4-fold increase in 30 years. Your parents will say rates were brutal back then too, and they're right, but that is not the whole story, not even close. But the number that really matters is not the price, it's the ratio. How many years of average salary does it take to buy the average house? Nationwide tracks this, going back decades. In 1993, you needed 3.5 times your annual earnings. By 2022, that had hit 8.3 times. You did not imagine this getting harder. The maths confirm it. Here's what a 1993 buyer looked like next to a 2024 buyer. In 1993, average house at £62,000, 10% deposit of £6,200, mortgage rate around 7.5% based on Bank of England base rate records for that period. In 2024, average house at £260,000, 10% deposit of £26,000, mortgage rate around 4.5% after the 2022 to 2023 rate cycle. Same percentage, completely different planet in terms of actual cash. Pause on that. The 10% deposit in 2024, around £26,000, is larger than the entire purchase price of an average home in 1993. That is not an exaggeration. That is the nationwide data read straight. The English Housing Survey, published by the Department for Levelling Up in 2022-23, tracked homeownership among 25 to 34-year-olds. It fell from around 67% in 1991 to around 38% by 2021. That's roughly 1 in 3 people in that age bracket who would have owned in your parents' era now renting instead. Same generation. Different numbers. But here's what most people get wrong. They blame the price, just the price. The reason this got so extreme is 3 things compounding on each other at the same time. 1, prices went up sharply. 2, interest rates fell, which let buyers borrow more, which pushed prices up further. 3, wages did not keep pace with any of it. It is not one villain, it's 3 of them working together. Here's the rate story in full. Bank of England base rate in 1990, 15%. Yes, 15. By 1993, it had come down to around 6%. It kept falling through the 2000s. After 2008, it hit 0.5%. By November 2021, the Bank of England took it to 0.1%, the lowest in their 300-plus year history. Those ultra-low rates did something predictable. They let buyers borrow more, and sellers responded by charging exactly that much more. And this is the cruel irony. Low rates were supposed to make housing affordable. Monthly payments did fall, but because everyone could suddenly borrow more, prices went up to absorb exactly that extra capacity. The monthly payment stayed manageable for a while. The deposit became stratospheric. Low rates did not make housing cheaper, they made the barrier to entry higher. That is the trap. Here's the number that makes this concrete. The nationwide house price index recorded a rise of around 20% between late 2019 and late 2021, the exact window when base rates were at their floor. 2 years, 20%. The cheap money got absorbed by the market almost immediately. It always does. Then 2021 to 2023 happened. The Bank of England raised rates 14 consecutive times, from 0.1% in November 2021 to 5.25% by August 2023. Anyone who bought in 2020 on a 2-year fixed deal came off it onto a rate more than 4 times higher. The affordability crisis stopped being only a deposit problem. It became a monthly payment problem on top, both at once. And the pain is not evenly spread. OAS housing affordability data for England and Wales 2022 shows the house price to earnings ratio in London running at around 12 to 1, the east of England around 9 to 1, the northeast closer to 5 to 1. The places with the highest ratios are exactly the places with the most jobs, which is not a coincidence, it is the mechanism itself. That is point 2 done. Point 3 is the uncomfortable one. Rising house prices are not neutral. Someone benefits. It's existing homeowners. Around 2/3 of UK households owned their home in 1991. That's from ONS census data. Their asset doubled, then doubled again. Their children now compete with other people's children to buy that same asset back at the new price. That is not an accident. That is the structure.
Here's the practical frame, and this is the third payoff. A homeowner who bought in 1993 at £62,000 and sold in 2024 at £260,000 made around £198,000 in nominal equity before costs. A renter over the same 30 years paid rent every month and built zero housing equity. The ONS Wealth and Assets Survey, published in 2022, identifies this gap as the single largest driver of wealth inequality between households in the UK. In the UK, the mortgage is not just a loan for a house, it is the primary mechanism through which wealth transfers between generations. That's the architecture, not a side effect. So what does understanding this mechanism actually change? 3 things worth knowing. First, the deposit is the structural constraint, not just the monthly payment. Knowing that tells you what problem actually needs solving. Second, rate rises compress demand and slow price growth simultaneously. That's the Bank of England's tool for cooling the market, and it worked slowly. Third, schemes like the Lifetime ISA exist because the data kept pointing at the deposit as the specific bottleneck, not monthly affordability. That's why it was designed the way it was. The maths your parents did was different, not because they worked harder or were smarter, because the ratio was different. 3.5 times earnings in 1993, 8.3 times earnings by 2022. Same house, same street, 2 completely different economic realities dressed up as the same problem.
If this changed how you see it, the video on why UK wages have not kept pace with inflation goes even deeper into the other side of this equation. And subscribe, we break this down every week.